Welcome back from lunch, ladies and gentlemen. We now turn to our third panel discussion, which addresses one of the most fundamental pillars of financial system resilience, trust. The panel is titled Rebuilding Trust, Crisis Management, Bank Resolution, and Deposit Insurance for a Stronger Financial Sector. We are honored to be joined by accomplished experts from central banks and financial authorities across the region involved in designing and implementing resolution frameworks and deposit insurance system. Please join me in welcoming Mr. Aru Sitasim, former Deputy Governor of the Central Bank of Sri Lanka, Mr. Tomoki Tanemura from Bank of Japan, Mr. R.L.K. Rao from Reserve Bank of India, and Mr. Arthur Young from Hong Kong Monetary Authority. Now let me introduce each of them formally. Moderating this important discussion is a seasoned and respected figure in Sri Lanka's central banking landscape, Mr. Aru Sitasim, former Deputy Governor of the Central Bank of Sri Lanka. With over 3 decades of experience in financial supervision, banking regulation, and risk management, Mr. Tasim has played a key role in strengthening institutional frameworks within the CBSL and guiding reforms in the financial sector. We are pleased to have Mr. Tasim lead this session. And our first panelist today is Mr. Tomoki Tanemura, Deputy Director General of the Financial System and Banking Examination Department at the Bank of Japan. Mr. Tanemura has been involved in key international financial regulations, including the Fundamental Review of the Trading Book and the Interest Rate Risk in the Banking Book, and is a member of the Basel Committee's Policy and Standards Group. He also represents the bank at the Financial Stability Board's Resolution Steering Group and leads efforts on public sector backstop funding following the 2023 banking turmoil. We are pleased to welcome Mr. Tanemura to this discussion. Now we are joined by Mr. R.L.K. Rao, Executive Director from the Reserve Bank of India. Currently overseeing the conduct and operations vertical within the Department of Regulation of RBI, he has vast experience in banking supervision, policy formulation, and international standard-setting bodies like BIS and FSB. He has also contributed to consumer protection and served as banking ombudsman in India. His current focus includes regulatory policy on licensing, governance, crisis management, and compliance. We are pleased to have Mr. Rao with us today. Rounding out our panel is Mr. Arthur Young, Head of the Resolution Office at the Hong Kong Monetary Authority. Mr. Young leads the HKMA's efforts to establish a credible resolution regime for maintaining financial stability. He also heads the HKMA's cross-border cooperation and policy discussions on resolution matters at the Financial Stability Board and other international forums. He is also the chair of the Study Group of Resolution under the Executive Meeting of East Asia's central banks. With extensive experience in resolution reforms and crisis management, he has contributed to designing frameworks, formulating policies, and strengthening financial safety nets and banking resolutions. We are glad to have Mr. Young join this important conversation. With that, we look forward to a rich and timely exchange of perspectives. Mr. Tasim, the floor is now yours.
Thank you, Steffi. Interestingly, a few minutes before we started this session, Tomoki was telling me that we are going to discuss such a gloomy topic of crisis management and resolution when there's so much of light and brightness in this hall. So, however, I think crisis management, recovery planning, resolution are some of the key topics that are now discussed nowadays in many forums because of its ability to provide orderly solutions and also help in maintaining financial system stability. So what we know is that many financial institutions do have all these plans, but nothing has been tested for many of them. So today we have 3 eminent personalities representing the Bank of Japan, Reserve Bank of India, and Hong Kong Monetary Authority, who have at least a part of their job in relation to resolution. So they will share their experience and knowledge with us on various resolution tools that could be used for crisis management and thereby contributing towards rebuilding trust and maintaining financial system stability. But we must remember each crisis is not the same. So different tools will be used in different scenarios. Having said that, the first round of questions, I will pose a common question to all three panelists. In today's highly connected global financial system, banking crisis does much more than disrupt bank balance sheets. It undermines public confidence, weakens trust in institutions, and challenges the relationship between the people of the country and the financial system. The loss of trust can trigger a series of economic and social problems that goes far beyond financial institutions. In an age where information moves faster than resolution frameworks can respond to, rebuilding public trust is not only a technical challenge, it is a test of leadership, transparency, and institutional resiliency. It requires prompt, clear action and strong commitment to long-term action to rebuild trust and protect the financial system's integrity. With that background, I would like to ask the question, what bold, I say bold, because in crisis, sometimes normal theories do not work. So what bold and effective strategies can financial authorities, regulators, and institutions adopt to credibly rebuild confidence in the system, and how can these approaches evolve to meet expectations of an increasingly informed and interconnected parties? So I invite Tomoki to open the session.
Thank you, Mr. Tashim and the CBSL colleagues for having me at this very distinguished conference. And I should say very congratulations to the CBSL for this 75th anniversaries. That said, as the Tassim introduced, it is very ironically thing to speak very negative side of the financial world, wordings is crisis management and resolution in this very brighter, beautiful island. So during the lunch break, so actually the curtain around these stage settings are actually lifted, but for this afternoon session, the curtains once again to hide our very negative side. But anyway, so let me begin by responding the first questions. Generally responding, the very bold and maybe an effective strategies to restore the public confidence in the financial system are certainly necessary. But it is also very important, essential to convince the general public that the measures taken are neutral, fair, and the only possible solution. So yeah, of course, I am now working as a lead for the FSB's public liquidity backstop work streams. If I recall correctly, the FSB's almost a very basic principle, key attributes, and following guidance give strong powers to resolution authorities to ensure the financial stability. So many jurisdictions, I guess I hope including, I believe hoping many jurisdictions here have developed their own resolution scheme based on these guidances. And FSB itself praised that their achievement that too big to fail reforms have well worked in 2021. But unfortunately, in just 2 years later, we observed the 2023 banking turmoil, which includes the Credit Suisse failure and the US regional banks. So key takeaways from the 2023 turmoil are not only the importance of the registration framework, but effective implementation and enhancing operational readiness for how the system is necessary. Also, we need to recognize, no matter how we prepare, as Tassim introduced, every crisis has a different aspect. So we should be humble. No matter how we prepare, maybe the new crisis will happen so differently. So we need to maintain the flexibility. Of course, it's based on the maybe key attributes, key spirits, like no need to for bailing out and no exposed the taxpayers' money to the loss. But we need to be very flexible. And based on that, I think that a bold and effective strategy is necessary. I stop here.
Thank you, Tomoki. And I think you raised one pertinent question that the regulators have to be flexible in a crisis situation. So over to Mr. Rao.
Good afternoon, and congratulations to Central Bank of Sri Lanka for celebrating 75th anniversary. And incidentally, Reserve Bank of India also completed 90 years last year, and we had a series of international conferences commemorating that. Now, getting into what Mr. Tassim has flagged. To my mind, trust cannot be built up in a short term. Trust has to be built over a very long period of time. And this trust is pretty fragile when it comes to public, the public confidence in a financial system depends on not only the players, the regulated entities, but also the regulator. So how, what kind of esteem that public holds the regulator in. So that's the key to the public confidence and trust. And that's a combination of various factors, various functions of the regulator, like regulation, supervision, then as a lender of last resort, the emergency lending assistance that the central bank does, and how robust is the resolution mechanism, and how strong and financially strong is the deposit insurance. So it's an entire financial safety net framework which gives the credence to the entire the financial sector. So that can come over only over a period of time. So how it happens is that when you allow only strong, fit and proper players to float banks, to incorporate banks and start doing business, and then constantly keep monitoring them in terms of their business model and in terms of their fit and proper governance, and how they are lending, how they are doing the financial services business. So you monitor them and ensure that you take early action, and also ensure that things don't reach the stage where the crisis will happen. So this is an effort from the regulator on a constant basis, but it doesn't mean that we'll be able to prevent any failures. It won't happen that way. So failures will happen, they do happen. So the question is, when they happen, so how are you going to react to that? So that is again a key. So there are various ways. As he said, there are no two crises are similar. So they require different customized and tailor-made responses. So which essentially means that it could be a package of how you bail out a bank, or provide liquidity if there is only a liquidity problem, or if there is any confidence issue only. Like I can give an example in India. A premier private sector bank, there was some kind of a rumor in the stock market that there was the shares of the bank are going to tank for some reason or other. So that created such a panic in the entire system that people started lining up opposite branches, branch offices and ATMs, and that became a nationwide phenomenon. So that is something very difficult to really manage and contain. So what we had to do was, in a very demonstrative way, in a public way, open up our currency vaults, continuously give currency to the bank to go and feed the ATMs in a very, obvious way and physical way, so that there is a clear image to the public that there is nothing wrong with the bank. And also we had issued a press release saying that the bank is fundamentally sound. There is no reason why public should be worried about it. So public should not panic unnecessarily and create a problem. So that press release was pasted everywhere in all branches and ATMs. So within a day, things quietened down, and when they realized that cash is there to be taken, so things quietened down very fast. So the reaction is both physical, financial, and also the communication, messaging, clearly saying that we are there and we take care of it. So that kind of the action sometimes also contribute to the credibility of the system and of the regulator. So I think that kind of, again, it's again not necessary that every time the same solution works, but it depends on each problem, and accordingly the solution has to be worked out. So I stop here and like to listen to others.
Yes, I think you mentioned trust needs to be built over a long period of time. and the entire financial safety net would contribute towards building that trust. So having said that, Arthur, what's your view on this?
Thanks. First of all, I'd like to join the others in congratulating Central Bank of Sri Lanka. Thank you for the invitation. It's a great pleasure to join the event. To the question, I believe in today's era of rapid information dissemination, trying to restore public confidence during a crisis with a single authority action is almost impossible, right? So people are flooded with information and the time to respond is greatly compressed. So to address this, I believe it's important for the authorities and financial institutions to focus on building and testing crisis readiness with a focus on fast-fail scenarios. So I'll highlight 3 key strategic areas to achieve this kind of readiness. First, a robust crisis management and resolution regime is fundamental. Authorities need to have the key legal powers and tools to address different kinds of failures. Consideration should also be given to the key elements in addressing a fast-fail scenario. For example, the design and readiness of providing public sector liquidity backstop, maintaining optionalities in resolution strategies, or the approaches to maintain access to financial market infrastructures. On the financial institution side, it's key for them to operate and structure in a resolvable manner, meaning that they need to have the appropriate legal structure, financial resources, and operational arrangement to support an orderly resolution if needed. Governance processes, internal procedures need to be in place to enable fast and decisive action in a times of crisis. In Hong Kong, we have established bilateral resolution planning program with each of our key banks, covering over 75% of the system's deposit. So we were trying to make sure all these banks will build the necessary capabilities to facilitate an orderly resolution without destabilizing the system. Secondly, this morning we talk about, the panel talked about the responsible AI adoption. Adopting technology is definitely a key area for crisis management as well. If possible, it would be great to integrate tech to monitor on a real-time basis the risk, a different kind of risk. In Hong Kong, we have seen banks develop tools to live monitor keywords on social media platforms. We as authority have also conducted research which leverage our in-house generative AIs to analyze market information and identify emerging vulnerabilities, which help us facilitate the monitoring of potential spillover risk. We have also made good use of payment system data to better understand liquidity flow and identify early signs of distress of individual institutions. So all these kind of measures will have their limitation, but it will be key to adapt them in a complementary manner to enable faster crisis response. Thirdly, I would like to say, echoing what Raul just mentioned, is kind of a long-term journey to build trust. So regularly engaging the key stakeholders in normal time will be vital. I believe events like this one will enable key stakeholders to better understand how our framework works to maintain financial stability, and what are the key expected actions of authorities and the financial institutions in time of crisis. This kind of engagement will help build trust and awareness, making people less likely to believe in and share misinformation during a crisis. I'll end by saying developing a robust resolution regime, integrating tech to monitor risk, and engaging stakeholders all require close collaboration between the authority and the industry. It's a long-term process. As someone who is directly responsible for these initiatives and who have been fortunate enough to get support, I'm now looking at all the central bank leaders here to say a strong commitment from the top will be key, backed by dedicated time and resources. Thank you.
Thank you, Arthur. I think you mentioned this crisis readiness. As I said initially, most institutions are ready, but it has not been tested. So we'll take another question going forward on how those things could be tested as well. And yeah, moving on to individual questions, I would, in a financial crisis, even the most carefully designed resolution plan can fall short if it has not rigorously been tested under realistic conditions. Ensuring operational feasibility goes beyond theoretical soundness. It requires regular simulations, coordinated exercises, and cross-institutional collaboration. Conducting crisis simulations, dry runs, and joint drills with key stakeholders helps to identify weaknesses, enhance preparedness, and strengthen the overall response framework. As financial systems grow increasingly complex and interconnected, the ability to translate resolution plans into practical, executable actions becomes a critical element of effective crisis management. So I would like to ask this question from Tomoki. How can financial authorities design and implement effective testing mechanisms, such as simulations and dry runs, to ensure that resolution plans are not only sound on paper, but truly operational in a real crisis scenario? What do you?
It is a very fundamental question. So as I said, the operational readiness is one of the key areas which the FSB's work stream is tackling on this year. And that's, of course, that background is saying is easy to enhance the operational readiness, but doing is quite complicated and difficult. So, of course, it's in addition to like a high-level clarification of the, like each concept. For me, I guess concrete example is to prepare an illustrative timeline for resolution and to share the necessary actions by each authority is quite helpful, especially for example, in Japan, resolution authority is a FSA, Financial Services Agency, but before the like a resolution, Central Bank of Japan is a main entity to provide liquidity, and after like a point of non-viability, actually so in my jurisdiction, Deposit Insurance Corporation will be a main provider of the resolution fund. That is quite complex, complicated systems, but to prepare such like an illustrative timeline among three authorities, when for example, the like a joint action is necessary, and how such like a point of non-viability is determined, such exchange information and increasing the awareness of the like a real situation is quite useful. So besides that, of course, we also require the private banks to provide a recovery and resolution plan under the like multiple scenarios, with less severe to the very severe scenarios, and also encourage the involvement of like senior board members, of course, CROs, which we believe that this is very valuable for increasing the seriousness of the scenarios and the preparations. That said, we have yet to conduct like a test or dry run with the authorities, but which is also a challenge for us. But with effective, maybe the external communication, it's quite difficult as well. So at last, maybe so we are also the very early stages to share such like a hypothetical timeline for the resolution to share with like foreign authorities. Of course, some Japanese banks have certain presences in the overseas market, so we invite many foreign authorities to our like crisis management groups. So some of them we try to begin to share such like illustrative timelines with us to increase our awareness itself. Yeah, let me stop here.
Just an additional question, Tomoki, is that this resolution activities, whether it is feasible to apply to a small institution which does not have any systemic impact?
Yeah, actually, that what I'm talking about is to apply the systemically important banks. Actually, for the very small banks and the small and medium-sized banks, we have a little bit different systems for the like, resolution. And Plan A is the orderly resolution, but Plan B, we are still not, we did not still remove the sort of like recapitalization measures. But this is actually, hopefully we don't want to repeatedly use, because that's, if such measures are repeatedly taken, maybe the moral hazard issues will be raised very easily. So we have a little bit different application.
Thank you, and you also mentioned about the Deposit Insurance Authority. So that poses the next question to Rao. Deposit insurance plays a critical role in safeguarding financial stability by protecting depositors against the loss of their insured deposit in the event of a bank failure. In the context of evolving financial landscapes, growing interconnectedness, and rising risk with digital banking, ensuring the credibility, adequacy, and adaptability of deposit insurance schemes is more important than ever. Furthermore, deposit insurance must be effectively integrated with broader financial safety net mechanisms and resolution frameworks to minimize the moral hazard and maintain the market discipline. So the question I like to pose is, in an era of rapid financial innovation and systemic interconnectedness, how can deposit insurance schemes be enhanced to maintain depositor confidence, ensure timely payouts, and support orderly bank resolutions, while also mitigating moral hazard and fiscal risk to the public sector? That's the question.
It's a very well-rounded question, and it has probably willy-nilly or unwittingly has made deposit insurance as a centerpiece of the entire resolution framework, where I have some reservation about it, because deposit insurance is a piece, is a part of the entire broader safety, financial safety net framework. As I said in the initial remarks, you have need a strong resolution, strong regulation, and then strong supervision, and then strong emergency liquidity assistance, and strong resolution, and then only deposit insurance. So they can only make payments in many jurisdictions. In some jurisdictions, they have the powers to supervise also. So there they are much more capable of noticing early warning signals, and they can do something about the health of the organization in such a way that the particular financial institution will not really reach a stage where they have to take the money from deposit insurance fund. So to that extent, if you really put it in proper context, and that is the role of deposit insurance, as we have seen, it is increasingly coming under pressure. And as it is, there are several issues with it, like moral hazard, where you increase the coverage for the sake of protecting the depositor. Then there are moral hazard issues, and it will lead to risky behavior by the regulated entities. So obviously you can't really maximize the coverage of the deposit insurance. At the same time, what is the optimal level, minimum coverage that you have to have? That is always a debatable question, and that is very keenly debated. There are various thoughts, various reforms are being thought of. One is the targeted coverage, maybe to ensure that if a financial institution is failing, the depositors who only do transact in the payment accounts, which do not carry any interest, so probably they should be covered in a different way. Maybe have additional premium and ensure that they are 100% covered. The reason is that the system, as we all know now, with the digital payments becoming almost, if not completely replacing, at least mostly replacing the cash transactions. So obviously, if there is a financial institution which is in trouble or illiquid, then how the depositors are going to transact? One is the depositors getting back their money, so that's where the deposit insurance will come into play. Whereas the payments and the transactions, so that how to ensure that there is no disruption. So to take care of that, maybe 100% coverage of the payment accounts would be required. I think that's where I see that in Japan you have that, which is quite unique among all deposit insurers. You have that. Even in India, we are looking at some of those options. The other option is maybe charge higher premium for those who want higher coverage. There is no such feature currently, but something can be thought of where you pay higher premium for a higher amount, because up to a point only, up to an amount limit only, the deposit insurer will protect the deposit. Then the other options could be, which of course are implemented already in many jurisdictions, that is imposing risk-based premium on deposit insurers. Depending on the risk that the bank takes, they have to pay higher or lower premium. So that is also an indication to the public that the particular bank or financial institution probably is taking higher risk, so they are paying higher deposit insurance risk premium. So that also can bring in some kind of market discipline for the financial institutions, so that the depositor is aware before he puts his money in that particular bank. So there are several options on the table for deposit insurance. However, I mean, that has to be thought of as a part of the overall financial safety net framework, and that's how it will help in the end. So that's where I stop. Thank you.
So deposit insurance is not the only solution. Okay, thank you. And Arthur, I think I'll go back to my first question itself, where I told you, where I said about the crisis readiness. While regulatory compliance sets the baseline for financial institutions' crisis readiness, true preparedness goes much further than just meeting requirements. Effective resolution plans require financial institutions to understand how they will operate under extreme stress, ensuring that systems, processes, and teams are ready to act in any situation. The question is, are institutions truly prepared for a resolution scenario, or is it compliance merely about ticking the boxes? My question to you is, to what extent are financial institutions prepared for a resolution scenario beyond mere regulatory compliance, and how can they ensure their plans are both operationally effective and resilient in times of crisis? Over to you.
Thanks. So just now in the break, in the lunch, where I was talking to other participants trying to make new friends, right? And when they heard about what I do, so resolution planning, crisis management, the first reaction or the question is that nobody wants to do that. So that's kind of typical challenges that we face when we want to push resolution planning to all financial institutions. So understand today there are some directors and senior management of firms here with us. So I thought before diving into the question of how prepared they are or how can we achieve crisis readiness, I will spend some time on the question of why. So why financial institutions want and should do resolution planning and ensure that they are resolvable. But if you know very well that firms can fail for countless reasons, credit losses from economic shift, a road trading decision, a cyber attack, or even a failure of a peer firm which triggered a run on your bank because perceived similarities issue. So when failure strikes, authorities may intervene to stabilize the situation with a resolution. But please don't assume you as the directors and senior management can just walk away, because resolution is costly. It's very expensive to the shareholders, to creditors, and to the wider public. So people will demand answers in the investigation that's following the resolution. And as directors and senior management, you will face harsh spotlight, right? So people will ask why the resolution is so costly. Have your firm prepared for resolution in advance? And if the answer is no, that won't look very pretty. And if the answer is no, even after the regulator had asked you to do so, that would be very, very bad, right? And I understand probably you are all very, very busy day in, day out, trying to address all the challenges and grasping all the business opportunity in the future world of finance. So the tariff, the private credit, the digitalization initiatives, et cetera, et cetera. Resolution planning with its, for example, TLAC debt, the system enhancement, et cetera, all could be very expensive and could just feel like a regulatory box to tick, right? I would just say, even if you think about that way, please resist the urge to let your staff low. Please don't kind of give them this impression, because that will be the first thing they tell the investigator after the crisis, right? My boss told me to ignore it, right? So please don't do that. It's really in your interest to do resolution planning in a proper way, and your leadership and commitment matter. In terms of how to ensure operational readiness and with effectiveness for resolution, I believe it can be summed up in the commonly known saying that plan is nothing, but planning is everything. Resolution planning is less about the plan itself, so really nobody will read a 100-page doc in a crisis. It's more about the ongoing planning process of developing and enhancing capabilities. For example, for financial resources, for liquidity projection, for valuation capability, restructuring planning, etc. It's also about rigorously testing these capabilities. For example, full dry run, full walkthrough, full independent review, full audit, full simulation exercise involving your senior management and the board. The goal is essentially to assure that all the capability built can be used as intended, and also to build muscle memory across the organization. And I would say through all these exercise and testing and initiatives, some of the key issues and challenges of resolution process will inevitably uncovered. For example, one of the common things I see in the board simulation exercise is the need to manage the conflict of interest between different entities, boards within the same banking group. So as crises emerge and stress build on different entities, the conflict over intra-group resources allocation and other strategic decisions will build. So there will be tension there. And additionally, if you have the same person sitting on multiple boards, it will add additional complexities. So it's very key for the firms to understand these potential challenges, clarify roles, and agree on the protocol to deal with this in advance, in peacetime, not in a crisis. I've seen firms implementing multi-year program to address all these issues, integrating resolvability into business as usual process. They have robust governance process in place to provide oversight. All the capabilities are critically reviewed by the top senior management, and they are continuously enhanced in line with the evolving business operation and also the market situation. Such ongoing commitment, I believe, will ultimately and most importantly foster a culture of resilience at all levels, ensuring everybody is ready to act when it matters most. Thank you.
I'd like to add a point briefly about the resolution plans. No resolution plan can be perfect because the problem, the crisis that happens with the financial institution differs from bank to bank and from institution to institution. So you can't have a completely, laid down document of resolution plan which will take care of all eventualities. It's not possible by the very design or very nature of the problem that is likely to come. That is one issue. We have also seen it in practice in Credit Suisse, the example of Credit Suisse, where the resolution plan couldn't be completely rolled out because they've encountered some of the practical ground level issues. So that keeping that in view, they have taken a very pragmatic approach to resolution, and that has worked in the end. So, but at the same time, the resolution plans help us in understanding, the way the organization, is structured, what kind of strengths and weaknesses, and how in a crisis, what needs to be done. Most of the things would be at least documented, so you are aware. And also, as you said, the trial runs and simulations bring in those experiences. So that will make it easier for resolution, though it's not a complete, probably not a complete solution, where just there is a problem and you start it and everything falls into place. It may not be like that. It may require impromptu kind of improvisations as you reach the crisis, and then only things will fall into place. Thanks.
Thank you. So resolution plans too will be evolving. Yeah, you also mentioned, Rahul, you also mentioned about communication to build trusts. I remember a good example where when Sri Lanka was in the economic crisis and Governor Veera Singha took over as the governor of the central bank, one of the key things that he communicated was a good example where he said, I cannot reverse the car. I can only stop the car from sliding down further. So that gave a clear message to the people of the country that the economic crisis cannot be resolved overnight. So having said that, transparency and communications aren't just for handling short-term issues. They are key to building long-term public trust in the financial system. As markets grow more complex and connected, clear communication becomes even more important for strengthening the resilience. This question invites us to explore how effective communication can influence not only the immediate outcomes of crisis resolution, but also the enduring confidence of markets, institutions, and the public at large. Now, this question I will pose to the panel. How can transparency consistency in messaging, and proactive communication reshape public perception, not just during the resolution of a crisis, but a lasting foundation for resilience and trust in the financial market. So I'll invite Tomoki to start.
Yeah, it is also raised a very fundamental question, and it is no easy silver bullet answers. Maybe let me begin with the bad example. It's a very late 1990s case, Japanese financial crisis case. Actually, so it's a quite old story and a bit shameful for me to speak in front of such a distinguished guest. But when a series of the Japanese financial institutions went bankrupt, we did not have the appropriate option to let them fail in orderly manner. So, and every time government tried to inject the public money to bail out, at the time, the finance ministers and maybe central bank governors announced that, okay, this is it. So we will never continuous like a bankruptcy will happen. But in a few months later, the other larger financial institutions failed. So the public began to, of course, it's totally straightforward, but the public began to doubt what the finance minister and the central bank governor said. This is a very worst case scenario, so we are not well prepared. And every time we say something with confidence, but that confidence will be overturned by reality. So I guess this is a really, really bad example of the communication. So let me take maybe the good communication. When I spoke to the, for example, the Swiss and the US colleagues after the 2023 banking turmoil, they admit that, of course, it's a public communication is quite important, critically important thing, but in the middle of the crisis, there's public communication, the prioritization, in their prioritization list, that they went totally behind. The how to contain the market is firstly prioritized, and less prioritized for the public communication. But in case of the US, I remember that FDIC, the US Resolution Authority, sued the SVB's management on the violation of a duty of care and negligence. So it is quite consistent with what the key attributes is thinking about. Of course, it's U.S. authorities declared the systemic risk exemption, which is quite rare and very ad hoc measures, which is not expected in advance. But after the declaration of systemic risk exemption and after containing the market contagion, U.S. authorities took a very consistent manner with their resolution plan and maybe the key attributes. And I guess that is, in the long term, maybe most of the US general public didn't know that FDIC is suing the SVB's old management. But this is a quite consistent way and quite effective public communication. So this is maybe the good example against the Japanese case.
There's always a question of transparency and communication. Transparency, how much of transparent you should be, and of communication, of course, is important to give the correct message. So, and you know, Rao, generally the central banks are found fault saying we are not the best communicators. So, in that context, yes, I'd like to have your comments as well.
Yeah, central banking communication is an art. It's not a science. Because it is not easy, I agree with Tasim there and Tomoki. But the question is how much you should communicate. Because sometimes there could be a self-fulfilling prophecy, right? If you say, if you exactly, completely, you are transparent about the problems in a financial institution, the damage that it's going to create probably is much more than what would have happened in the normal course. So at the same time, you can't really hide things from the public. So where do you draw the line? How much you want to be transparent about? So that's a huge call that needs to be taken. Yeah, we have also recently seen in India a bank where there are certain irregularities in some intra, kind of departmental deals, internal deals on derivatives, which are not properly, assessed, and there's a profitability was kind of not properly reported. So that since banks are listed and there is a very quick investor awareness about it, and the shares start, coming down in value, and so that at the time, so the question of timing there, when do you really assure the markets that, of course, assuring the investors is not the job of a central bank, but assuring the depositors that their money is safe is definitely the job of central bank. So at what point of time you would communicate and how much you would communicate. So we had to put very generic kind of press release saying that certain things have been noticed in the functioning of the bank, but at the same time, broadly, the financials are reasonably good, and no need to panic and all that. So very generic kind of communication. And also this should be accompanied by very good positive news from the bank itself, from the board and the MD, CEO of the bank, being open about things and interacting with the press and media, and then clearly articulating what is the problem, so that it kind of supports the regulator's view and regulator's communication. So these kind of messaging right from the regulator, from the financial institution which is in some kind of crisis, to assuage the fears of the public would help. That is the experience of India in this case. Thank you.
Thank you, and over to you, Arthur.
Yeah, so I believe it's about communication, it's about trust, right, essentially, and it is essentially the invisible currency that keep markets continue functioning. Trust itself is profoundly shaped by how we authorities and the government communicate. I believe in the past couple of weeks and months we have seen a lot, maybe too much, about what unpredictable communication can bring to the global markets. Tomoki and Rao have mentioned a lot of the key consideration in this communication, both in crisis, and in normal times, the consideration of these. I thought I would just illustrate the importance of transparent and proactive communication with a couple of real-life examples. I'm sure you have heard of these examples, but it's good to put them together to stimulate thoughts, I thought. First one is the ECB's response to the Eurozone debt crisis in year 2012. So that's a classic example of crisis communication. As borrowing costs soared for certain European countries, the market speculated the euro might eventually collapse as well. ECB President Mario Draghi stepped forward with a clear and decisive message, whatever it takes to preserve the euro, right? That message provides a psychological lifeline, and by pairing it with concrete actions, so that's the our monetary transition program, the ECB claimed the markets quickly. We saw another example in year 2020 during the COVID-19 market meltdown. As panic spread, US Fed Chair Jerome Powell announced unprecedented stimulus measures, and he framed them with an unflinching resolve: we are not out of ammunition. So that message helped investors, businesses, and general public understand that the authorities were ready to take bold actions. And the result is that markets stabilized faster than many predicted. By contrast, the collapse of Credit Suisse 2 years before in 2023 was more a mixed story. At the height of that crisis, a major shareholder of Credit Suisse made an ambiguous comment about its inability to provide further financial support. That message was further traced by the people and led to a catastrophic loss of confidence in Credit Suisse. Then, as the authorities orchestrated swift takeover by UBS to stabilize the situation, the actions of writing down AT1 bonds ahead of equities trigger another round of volatility in the AT1 bond market globally. So authorities from Asia to Europe had to respond promptly to the incidents, reconfirming the hierarchy of creditor claims. In that scenario, fortunately, the clear and coherent messages from the authorities were well received by the market, and order were restored within days. Trust isn't just earned during crisis, it's also cultivated daily. Turning to communication in normal times, I'll use HKMA example. We do frequently engage with the key stakeholders, with the public, through all different forms, through publication, through articles, through interviews, meetings, etc., to explain our policy directions, market situation, our key initiatives, etc. We have also been very active in ensuring our message could reach all the target audience through different channels. Earlier this year, we opened a new account on social media, the Little Red Note. So that marks the 7th social media platform on which the HKMA operates. I would just say, in closing, the effective communication is kind of like a team sport. You really want to score a goal, just as you want to communicate very sharply in a crisis, but you can't really do that without day-to-day practicing and the trust building. I believe every engagement and interaction with stakeholders in normal time is a step towards that goal. I'll stop here.
Thank you. And Arthur mentioned about social media. Rao, is there anything you can add on that, how RBI uses that for the communication?
There's nothing much there except that we are present in social media and also we do respond promptly to any comments that come on the social media. But we are in the process of developing some new technologies like AI and all that, which do the web scraping and also social media scraping wherever any comment or any complaint or any kind of rumor is developing against a particular financial institution, this solution can pick up those signals and then kind of alert us so that we are also kind of ready to decide when to intervene and say something as a part of our messaging. So that's in the pipeline. So, but again, I think central banks need to leverage on the social media much more than what they're doing currently. That's what I feel.
Thank you. Then comes to the new player in the financial system, that is the fintechs. The rapid growth of fintech firms and digital-only banks is reshaping the structure of modern financial systems. The technology-driven entities offer innovation and efficiency, but also introduce new operational models, risk profiles, and interdependencies that challenge traditional regulatory and resolution approaches. As these firms gain systemic importance, handling payments, deposits, and even credit intermediation, resolution frameworks must adapt to ensure they remain effective, credible, and operationally viable in the digital age. Proactive evolution is essential to prevent regulatory blind spots and to protect financial stability in a landscape that is being transformed by technology. So I pose this question to Tomoki. How should resolution frameworks evolve to address the unique risks and structures of fintech firms and digital banks, ensuring that the innovation does not outpace resilience in the event of a stress or failure? Over to you.
Thank you. It's a very interesting question. Maybe such a, by responding such a very interesting question, I should be very proactively or maybe provocatively responding. But actually, so as for fintech firms and the digital banks, of course, the speed and the volume of the deposit outflow will probably be faster and larger than those of the traditional commercial banks, as shown in the SVB Silicon Valley Bank's case. But I think the other than a deposit outflows case, the traditional elements of the a resolution plan would be similar or same as the for the digital bank and fintech firms case. So of course in the SVB case, it would be ideal for the authorities check the more conservatively whether the deposit was insured or uninsured, concentration risk, and maybe that's whether the bank has a highly liquid asset which could access to the central FRB's lending facilities. But I believe that another checklist should be the same with the as a traditional commercial banks. So in this context, maybe that's a regular supervision of the fintech banks and digital banks should be prioritized rather than preparing the resolution schemes. So in US case, those business and deposit increases under the COVID-19 pandemic was quite dramatic, and its limit is, I guess its volume of the balance sheet size exceeded some of the ceilings of the US predefined case. But unfortunately, the FRB failed maybe that they did not escalate the monitoring levels of the SVB, and SVB has failed before the how to say the SIV measures are taken. So maybe of course in jurisdictions with the young generation, maybe in your country, not in my country, I guess it's the fintech firms and the digital banks is likely to grow very fast. So effective supervision should be much prioritized, and maybe the effective supervision may be more relevant to in line with the asset growing pace of fintech firms and digital banks. That's my short answer.
Thank you, Tomoki. And I think with that we moved into area of technology actually in the financial system. So technology is transforming the financial sector at an unprecedented pace, bringing both opportunities and vulnerabilities to the forefront of crisis management and resolution. On the one hand, increasing digitalization introduces operational risks, cyber threats, and complex interdependencies that can amplify the impact of a failure. On the other hand, technology offers powerful tools for early warnings, crisis simulation, real-time data analysis, and more efficient coordination among resolution authorities. As the financial ecosystem becomes more digitized, understanding how to harness technology as both a safeguard and a strategic enabler is essential to build resilient resolution frameworks. In this background, I would like to pose this question to Rao. What role does technology play in the resolution process, both as a source of emerging risk and as a tool for enhancing preparedness, execution, and coordination during a financial crisis? Over to you.
I would like to say that technology is a bad master but a good servant, right? So technology used to be harnessed. When you rightly said that technology makes the process, the business more efficient, more productive. So that's where all the benefits come. Yes, but it also brings in its wake the problems and the issues like cyber security issues and or the technology outages. I mean, when your systems fail, then sometimes it can lead to the failure of the bank also. So to that extent, there are issues with technology, but I am not sure whether technology can single-handedly bring down a bank. Generally, as we have seen, the banks are brought down for very fundamental reasons than technology. If you see the even 2023 bank failures, take the case of Silicon Valley Bank, it failed for more fundamental reasons, right? I mean, I would like to give a cricketing analogy because the cricket is most popular in India and Sri Lanka also. So many times teams fail due to not following basics properly, right? Basics of doing good batting, good fielding, good bowling. These are the basics. So if you don't do the basics properly, then you are more likely than not to fail. So Silicon Valley Bank, as we know, I mean, they are heavily concentrated on both sides of the balance sheet. I mean, that is a recipe for disaster. And also they are exposed to interest rate risk massively, right? And 97% of the deposits are uninsured. And there are huge deposit concentrations that to a particular set of companies in Silicon Valley, right? So it is very likely that all of them were, there is a kind of herd behavior, and all of them are likely to move in a particular direction in terms of withdrawal. So that was waiting to fail. That bank, it is a surprise how it continued for so long. Anyway, apart from that, the business model considerations, normally they are the cause for the failure, and technology definitely can help, and at the same time technology can bring its problems. But in this specific case, I would like to kind of take the discussion to the digital bank runs, right? Where now we are all aware that this digitalization and the fast payment systems and the social media explosion essentially can make deposit bank runs very faster. Yeah, that is true. If you see the last two big failures in US, Continental Illinois, and then Washington Mutual. Washington Mutual failed in global financial crisis. So these two banks, there was a proper physical bank run where they paid something like 20 to 30% of the deposits over a period of 10 days, 20 days, like that. That too only 20% of the deposits. But in case of, as we all know, Silicon Valley Bank, 25% of the deposits, I think $40 billion were withdrawn in a single day. Okay, and next day it was scheduled, I think 62% of the deposits were scheduled for outflow. So a total 87% of the deposits were to be withdrawn in 2 days. Which bank in the world can survive this? No one, practically. So yes, the digital, age, bank runs are pretty serious too. But at the same time, we have to also put it in proper perspective. In case of Silicon Valley Bank, the withdrawals were happening through wire transfers, which were done by these large depositors, right? So they have that, and there are no limits there. They can withdraw entire amount. So if you look at the retail deposits world over, no bank allows entire 100% deposit to be withdrawn, right? There are daily withdrawals, limits. There are limits set for daily withdrawals. Even in ATMs, there are cash withdrawal limits are there. So even if there is a problem with the bank, it is not that a depositor can 100% withdraw entire money immediately, instantly. There are ways to keep it at check and put some limits and have more orderly withdrawal of deposits. So in case of Silicon Valley, that's what happened, where bulk withdrawals, wire transfers were allowed, and that kind of created the issue. So I will say that yes, the digital bank runs are pretty serious. We really have to think about how to respond to such situations. But at the same time, in India, we have this concept of moratorium, which is, I think, prevalent in some of the European jurisdictions also, where there is a problem in a bank, serious problem, which needs a resolution. It could be any way, it could be any form, like you can probably merge it with another bank, or find another suitor and compulsorily merge it, or voluntarily merge it among themselves, or even kind of revive it if the shareholders are willing to bring in more capital, or even do reconstruction. What we did in India in one case, where we asked the other major banks to come and invest in the failing bank, so that the bank's capital structure was restructured and the bank continued to survive and prospered later. So these are the solutions that are available. But the point is, you cannot, do it while running. You can't resolve a bank while it is running. So you need to stop. You need to put a stop to the operations, put moratorium on withdrawals. Doesn't mean that complete stop of withdrawals. Put some limits so that people can withdraw, which will take care of their necessities. But at the same time, they can't withdraw entire amount. If they withdraw entire amount because of run, then no bank will survive. So this moratorium will be usually for a few days, and by which time you find a solution. So normally what happens is that you find a solution first and get a suitor or find a clear solution, then put a moratorium, and within few days you resolve a bank, and so that you lift the moratorium, so that the inconvenience to the depositors is very limited. So that's how we go about in India. Thank you.
Surao, your call is that technology will not bring down a bank despite its threat, but public confidence will. Okay, thank you. And I think we have touched on rebuilding trust, communication, technology. Now it's time to move to governance. As financial institutions and markets become more complex, effective resolution planning requires not just solid technical frameworks, but also strong governance and organizational structure. And also the ability to respond quickly and effectively during a crisis depends on the internal structures, decision-making processes, and leadership mechanisms. The challenge is ensuring that governance is not only compliant with regulations, but is also flexible, responsive, and prepared to handle the unpredictable nature of modern financial crises. This means institutions must rethink their organizational setup to balance regulatory adherence with the ability to adapt in real time under pressure. So Arthur, I'd like to pose this question to you. What key governance and organizational changes are essential for ensuring effective resolution planning and execution, and how can institutions proactively position themselves to respond swiftly and decisively during these times of crisis? Over to you.
Sure, thanks. So I guess in terms of governance and management structure for resolution, the first thing to realize or to recognize is that we are not creating something from scratch, right? So there's already all sort of crisis management framework already in place. There are a very robust framework. And the fact that crisis is a continuum means that whatever we do for resolution, the arrangement should not be a silo framework there. So it should be integrated into the firm's existing overarching crisis management framework to ensure a seamless transition from business as usual to recovery to resolution process. So that's first point. The other point is that the governance arrangement for resolutions reflect the severity of resolution process itself. One distinction of resolution from general crisis, stress or recovery scenario is that it typically involves much more severe action. Very often franchise damaging actions need to be considered. So the nature of these kind of actions and decision itself demand the direct involvement of the management, senior management, and the board of directors. So the governance arrangements must ensure the most senior leaders are equipped to make this tough calls under a very strict time pressure. In my experience, very concise internal playbook and simulation practices will be very helpful. The other thing is that we all recognize speed is crucial in terms of crisis, but so as a proper oversight. So balancing this prompt response and robust governance is typically a challenge that firms will face. In practice, I see some firms have adopted a crisis management streamlined approaches whereby they will do combined meetings instead of going through layers of approval to save time, but at the same time making sure that all the decisions made in the crisis will be defensible. Resolution itself could also be a very complex process involving inputs and expertise from a wide range of different functions, say finance, asset liability management, liquidity, communication, operation, also your client-facing staff, etc. In terms of management structure, typically what I see is that banks will put in place a dedicated resolution team and also assign a senior executive accountable for resolution planning and execution. So this dedicated team will be responsible in normal times coordinating the capabilities buildings and also firm-wide simulation exercise to build readiness. In an actual crisis, the very same team is expected to be the linchpin. They should be coordinating and synthesizing complex cross-functional inputs and supporting senior management in responding to the crisis with informed decisions. So I guess I will stop here. Thank you.
Thank you, Arthur. I think we are nearly come to the end of the session. We can take a few questions from the audience, please.
Hi, my question is, I think generally when we talk about resolution and the requirement for something like deposit insurance, it generally tends to happen in a context of an economy-wide slowdown or crisis and the like. in which you have other economy-wide problems coming through. Interest rates are rising, prices are rising, duration is shortening in the financial system. And at a point like that, the ability to actually funnel capital into resolution might face other constraints that are more directed from the overall economic performance. So I just want to understand how you would think of that particular use case and how that you would distinguish that from a point where an individual player might require resolution outside of a crisis.
I think the question was on individual resolution and then the system-wide impact, how would that? So, can answer somebody.
Couldn't completely understand.
I think your question was.
Not particularly clear?
Yeah, again, yeah.
I think my point is that you do have context where you need resolution of the of individual players in the financial system for specific reasons that are conducive to that individual player, versus context where the entire system going through, and the context in which the system is under stress is where you anyway have capital and financial system pressures, rates are high, liquidity is low, capital is scarce, duration is shortening. So when you have an overall problem that's already at play, how do you think of the problem of resolution in that context?
Yeah. Maybe I'll just quickly respond, maybe you can also respond. To the extent that I understand the issue, I think the classical example is very recent, that is Silicon Valley Bank, where certain mid-sized and small banks were kind of kept out of certain regulatory frameworks like stress testing and all that. And they have grown substantially. If you take Silicon Valley Bank, it grew, I think, some $57 billion in 2018. And in 2022, it became $212 billion. So almost 4 times it increased. So such a huge growth of a financial institution is clearly a problematic thing. But the point is, the way their balance sheet was structured, there are several other banks which are similar in the US. So obviously that situation is relevant to the extent of what you're saying, where the problems are only localized, idiosyncratic, pertaining to only a particular entity, then it has got different solutions. But when it comes to a situation where other players in the system also have the similar problems, and if one falls, there could be a domino effect, and others also might fall like dominoes. So that is a kind of risk, and obviously the FDIC had to invoke systemic risk exception, and then guarantee 100% of the deposits of SVB, so that the public confidence does not is not get dented, and should not lead to a situation where entire system will be in some kind of trouble and the financial stability will be threatened. I think that's where the point is. Wherever it is idiosyncratic, that is to that extent damage can be contained and solutions can be found. But where it is a system, obviously one has to invoke the take out all the tools that are available in your toolkit and ensure that the problem doesn't become contagion. That's my 2 cents.
Let me take example of the Credit Suisse case. That case is fully examined, explored by a Swiss parliament as well as a Swiss financial authorities, FINMA. According to the report, until the last minute, the authorities seek the orderly resolution as plan A. But finally, so the authorities and of course the UBS decided to merge with Credit Suisse. So at the initial stages, the FINMA colleagues explained that this is a private merger with a government guarantee. It's very tricky, hybrid schemes. But I guess it's the most important factor is to take such a really strange hybrid scheme is, of course, it's the systemic presence of a Credit Suisse in international financial market. As Rao said, even if the orderly resolution, it could have the domino effect on the international market. As you see, maybe there, for example, as week later, the Deutsche Bank was in the turmoil. And of course, the Deutsche Bank was not saved, and they were rebounded, and they were the healthy banks. But if I guess it's this is my personal guess, but the Swiss authorities take seriously fear that if even in the orderly resolution will trigger international global financial systemic risk once the Credit Suisse will be determined as the resolution. So maybe it is not like a mechanical, there is no mechanical judgment on every case. So in Credit Suisse case, maybe from very holistic perspective, Swiss colleagues have taken into every element into consideration. That's the result.
Thank you, and we can take one more question here.
If maybe just very quickly, just to add my 2 cents to that, I think it's important to recognize that resolution is designed primarily for idiosyncratic scenario. It's designed for one firm's failure, mainly maybe a very big firm, but it's not designed for multiple firm whole market failure. It's very important, and that's why when we do resolution planning, it's very key to consider the potential secondary effect of the resolution action, even if the resolution action itself could save the failing firm. So it will have secondary effect. The particular consideration will be on the funding arrangement. So regardless, assuming you are not using public fund, right, the primary strategy use private sources, then whether you are using it in an industry form or asking the firm to issue TLAC in advance, that will have secondary effect. So the industry-wide firm, for example, in the 2023 crisis, we see the US use deposit insurance fund and expose it will leverage from the industry. So essentially it's owned by the industry. If you are asking the firm to issue TLAC bond in advance, when you pay in those bonds, the creditors will feel the impact. So depending on who are holding those creditors, it could be an NBFI, it could be other key financial institution in the jurisdiction, which may eventually become another crisis of itself. So it's just something that we need to bear in mind when we do our planning. Thanks.
Thanks. Yeah, one final question.
Yeah, first of all, thank you very much, and I would like to congratulate the moderator and the panelists for such high quality discussions. I have one small comments and one question. The technology, I have heard, and very rightly, technology is a bad master but good servant. Now the issue is that there's something is called particularly in the financial sector, the new and emerging technologies and the responsible one, something is called ecosystem of digital public infrastructures. By designing the technology in such a manner that the techno-legal aspects are embedded into it, open, responsible, and interoperable technology, it can be designed in a manner which is the ecosystem that itself can minimize a lot of risks and other challenges while giving the solutions at its scale. So that is happening, so therefore that could be one of the model. Second thing, I was trying to understand that while the communication as a central bank or regulator is quite important, and transparency. One small, I wanted to hear thing, whether you would like to highlight about the timing and the interval, like how the regulator or central bank communicates. Is it there should be a time period or something like every morning you should as a bank, or like see, we get to hear what is new, what is not new, like communication, basically the interval or time. That's what I wanted to. Thank you very much.
Shall we start with Arthur?
Okay, I guess maybe I will try to respond to the technology question. I guess it is indeed, as Raul also mentioned, is potentially posing challenges and opportunities for us in managing the crisis. I guess looking at the recent bank failures in 2023, key thing will be the speed of event and also the liquidity issues. Looking at the structure of a bank, we are seeing that technology advancement have enabled banks to serve its clients in much more efficient manner. So And as a result, its depositors can pull out its money very quickly on the liability side. But on the asset side, we are not seeing the same advancement in terms of mobilizing the assets for liquidity. So I guess what I'm trying to say is that, of course, the technology will have its challenges, but I do agree that in the future, there will be opportunities and room for us to consider more fundamentally, including in a system-wide infrastructure level, whether there's opportunities for us to make things easier for banks to get liquidity and therefore help better address the crisis.
Yeah, I would like to comment on that issue of communication and the intervals and things like that. What I feel is there is no successful formula here, successful model here. It depends on situation. Every time, depending on the particular nature of the crisis, the communication has to be accordingly tailor-made, right? So I'm not sure there should be a kind of regular bulletins, right? Every morning coming and briefing is probably not required, in my view. It's my personal view. But at the same time, when the public expects regulator to speak, and if you cannot afford not to be missing from there, you have to be there to, and at the same time, it is also it's a kind of complete strategy that you have to kind of make it along with the regulated entity as to how you, what kind of things you are going to present and how you have to demonstrate to the public that they need to maintain confidence in the regulator as well as in the regulated entity and the system. So that so it goes as a complete package. It is not any specific parts of the strategy. That's where I stop. I've been talking too much.
I don't know if it's a good example or not, but actually, so in my jurisdiction, the central bank governor is of course respected, but is regarded as one of the very hardest working guys. He's very well frequently called by the parliament to make any economic explanation about the Japan's performance. And after the each monetary policy meetings, he has to attend 1 hour press conference. And after the international meeting, like a group 20 or something, together with the finance ministers, he needs to respond from all questions from the media. But yeah, I saw my governor is so exhausted after the press conference. Maybe that in the Sri Lanka's case, it's similar. But with the accumulation of such a very critical and accumulations, I guess it's public trust in the central bank is slowly but steadily increasing. So I guess such a very critical measure should be taken everywhere.
Thank you, and I think we have come to the end of the session. Even though the subject matter was gloomy, I think from the responses we had from the panel, there is light at the end of the tunnel. So having said that, thank you to all the three panelists for this valuable input. Please join with me a round of applause to the three panelists. Thank you.
Thank you, Mr. Tasim, and a sincere thank you to our panelists for that engaging and thought-provoking discussion. As a token of appreciation for your valuable time and contributions, we would now like to present tokens of gratitude to our moderator and panelists. For this, may I kindly invite Ms. Nelumani Dawlagala, Senior Deputy Governor of the Central Bank of Sri Lanka, to the stage to present the tokens of appreciation.